NVIDIA stock is the talk of the town. They have changed their business model again, and now they're focusing on AI, and it has caused the stock to absolutely parabolically rise. Guys, this is a stock that was at 108 per share. How long ago, Mo? Let's go back.
2022, and also it opened at $8 trillion market cap this morning.
Yes. So it hit in October, hit a low of 108.13, and now it's at 410 per share. All-time high hit today of 419.38. Guys, NVIDIA is riding the AI boom. They're the big leaders in it. They're self-proclaimed big leaders in it. So the question is this a stock that's overpriced? Is the hype worth it?
My name is Mo, that's Paul. We are investors, and we are different from other people. We look for a very specific process in order to buy a stock. So for NVIDIA, we're gonna look and say, is this overpriced? Is it in our wheelhouse? But we're gonna stick to the same process that we always use to evaluate a company.
We have two fundamental beliefs about investing. One, that when you buy a stock, you're buying a piece of a business. And two, every investment's the present value of all future cash flow. That might be a lot to understand right now. Just stick with us. We're gonna go through a lot in this video. There's gonna be a lot of basics going in, and we're gonna get more and more into the weeds as time goes on in this video, including a culmination of us using our stock analyzer tool that will allow us to make assumptions about the future on every stock we look at, and it'll tell us what we should pay for that stock today based on those assumptions. So guys, AI is a big driver for NVIDIA. What's AI going to entail? We have no idea. We're in the very early stages of AI, so obviously everyone has found the new hype train, but I want to remind everyone, the internet was the hype train 23 years ago, and the internet grew like crazy, but go look at some of the stocks, go look at the vast majority of stocks and what they did. EV was the big thing, cannabis was the big thing, crypto was the big thing, and crypto's still going, but it's down from its. I want you guys to get an idea of what I'm saying here. If you're new to the channel, you're gonna know from watching our videos, when you subscribe, that I don't follow hype. I eventually will buy into, but I want more stable revenues, profit, and some sort of opportunity to buy a good company at a great price. And I do think those exist. It's hard to avoid the hype train. When you see this, what do you think?
Buy.
I missed out, right? I have to buy.
And you see things like NVIDIA collaborates with Microsoft to accelerate generative AI. You think, I have to be on that train. And if I'm not on that train, I have to catch the next train because I missed this one. Don't jump into that.
Remember, look at Workhorse, look at NIO, look at Nikola, look at all these companies that were part of the EV hype train that we said, be cautious, you need to avoid these. They're all down 90, 95%.
Even Tesla.
And we still think Tesla has a lot more to go down. So is AI going to be a big part of the future? My guess is yes. Just like I think electric vehicles are a big part of our future. Just like I think legalized marijuana is a big part of our future. Just like back in 2000, the internet became a huge part of our life. But if you're young and you don't remember those 2000 days, go Google all the .coms that went bust. Go Google all those tech companies that went bust. It's a huge number. And all we're saying is be cautious because it's really, really hard to recover from a 99% drop in your investment. And that's happened a lot. We've seen it happen from all these YouTube hypesters out there that have sat there and they bought the hype and they lost 90, 95% of their money. Have our investments gone down? Absolutely. We've had a few go down quite considerably. But guess what? We're buying cash flowing businesses, and as their stock price goes down, we want to own more of them. That is the difference. But when you buy on hype, if the stock goes down, what are you buying? What are you doing now? If you don't know why you're owning, you're not going to know why you're selling. But you're only going to have fear. And our big goal here on this channel is the more you know, the more you understand, the less you will fear. That's very, very important in all investing. But fundamentally, I look at these metrics down below. Now I want to remember, do not do anything because I'm doing it. You need to understand your own process and do things because you've determined the right way for it. That's why as a channel, we're trying to teach a process. We're not trying to give you shortcuts. Mo's our trading expert. He looks at charts a lot. He looks at moving averages, but he'll never tell you you must go do this, right? He wants to teach you what to look for and to go implement.
Yep. All right, so let's look at a couple of bull and bear cases. So bullish, this is maybe news to a lot of people out there. They do more than just AI. They are involved in the automotive world. I mean, both of our Range Rovers have NVIDIA chips in them.
Oh, really?
That's the graphics card. Yeah. So their revenue for automotive has increased 114% year over year. The company has an estimated $14 billion pipeline, partnerships with Jaguar, Land Rover, BYD, and Volvo. And
BYD too?
Yeah. And the list continues. So they're also, compute and networking segment has increased 21% since May of 2022.
Listen, I bought 3 computers in the last year. All of them had NVIDIA graphics cards as well, and chips.
And that makes up 62% of their revenue from the quarter and ending April 30th, 2023.
Of course.
So they do a lot more than AI. And that's the big thing here is you have to factor in what they've actually been doing, not just the hopes and prayers that the company could do.
Yeah.
But going on to the bear side, they're big in gaming. Gaming revenue is down 38% year over year due to weak demand, lower shipments, et cetera. So I guess.
Really?
Yeah. I mean, but think about it. It's coming off of those COVID, the big spike. Everybody went and bought something.
Yeah, because everybody's at home, so they spend a lot of money on gaming.
So now it's coming down. So yeah, 38% down year over year looks bad, but compare it to what happened the previous year. Maybe it was up 100%. I don't know what the number is. And last bear case here, stock-based compensation has increased 27% since May of 2022.
So guys, stock-based compensation is something to look at because it is going to cost you. It's diluting investors. And as Warren Buffett says, if it's not an expense, what is it? And a lot of investors will take the free cash flow, which we explained, cash from operations, that's your capital expenditures, and then also subtract out stock-based compensation. Because if you're issuing a ton of shares, which happens a lot in tech businesses, to recruit people, that's a cost in some fashion.
And we're starting to see this a lot more across the board. I don't remember hearing a lot about stock-based compensation to this level since end of 2021 into 2022, and definitely now.
Yeah, I just don't know if we weren't just, I don't know if it was just a big thing because there was nothing to really, the market was going up, so I don't think people care.
So maybe that could be the case. I've definitely, like when I look into bear cases and stuff, I'm like, oh, there it is again. So maybe people are just pointing it out now.
Yeah, maybe so.
Yeah. Okay. So that's bull and bear cases for on top of all the AI stuff with NVIDIA.
And we look at NVIDIA here, Mo, just from a chart perspective.
It's an interesting chart.
This is a parabolic rise.
This stock is moving like a $5 billion company. You wouldn't think this is a $1 trillion company the way that the price is moving.
So it's interesting you say that, Mo. So this morning I was having a conversation with my brother who was crying in my office going, what's going on now? And I said to him, I looked at the NEO, the workhorses, all those other companies, and I sat there and said, I chose not to enter shorts on them. The reason being is they were $5, $10, $20 billion at the time. Those can go to $100 billion
easily,
very quickly. I am shocked by this. This even floored me.
Those can go to 100 billion as fast as this went to $1 trillion.
Exactly. Now I look at this, and this market cap is $1.02 trillion. Now, let's look at another company. And look at this. A big thing for me is price to sales ratio. This is one of the biggest metrics I look at when a company is growing. Because you want to sit there and say, okay, is the value too high? Because usually with growing companies, the PE of 184 can be misleading. But this is a high PE for a company that even 6 months ago was a $250 billion company. Remember that. Just 6-7 months ago, it was valued at $250 billion, and now it's $1 trillion. They did $25 billion in revenue. Let's compare this to Microsoft. Let's compare this to a very mature, cash-flowing business. And I know you're going to say out there, you're going to say, Paul, Microsoft doesn't have the potential that NVIDIA does. Okay, well, Microsoft is $2.4 trillion. It's got $207 billion in revenue, 8 times more than NVIDIA. Look at the price-to-sales ratio, 11.9. Look at the PE, 35. So at some point to say, are we just paying too much for NVIDIA? And if you say no, I would sit there and say, okay, well then what's a reasonable price? What's a reasonable price for NVIDIA? Because I feel like the people who say no focus on this and not the fundamentals. Because remember, price is what you pay, value is what you get. If I showed you a Ferrari, a beautiful Ferrari, the best car in the world, and it's selling for $300,000, according to the logic about it's a great thing, pay $3 million, pay $30 million. At some point, to sit there and say, no, it's not worth that. And that's all we're doing as investors. That's it. We believe there is a price that is too much for a good thing. And there is a price that's too low for a bad thing. It is possible to have value in bad things as well. Now, as a channel, we've transitioned our belief now to buying great companies at great prices. Now, there's the old adage by Warren Buffett, I'd rather buy a great company at a fair price than a fair company at a great price. I believe it's possible to buy great companies at great prices. You just have to value them differently. Now, could NVIDIA be one of those great companies? Absolutely. NVIDIA probably is one of those great companies. But then I sit there and say, well, if not 408, Why not 508? Why not 608? Why not 708? Why not 8,008 per share? Now, it's easy to say that sounds ridiculous, but I'm quite sure in October, when the stock was at 108, if I said 408, you'd have said, well, that's a little ridiculous. Not maybe you, but people out there would have said that. Because we all anchor to this price. We all anchor to the most recent price up here, 408. And that's what's a big part of this channel. So let's go look at some more fundamentals. If you know our channel, we have our 8 pillars. We talk about this 8 pillars a lot. Essentially, it started from me just naturally going through companies and seeing high level what I liked. And for those who are part of our community, there's a lot of repeat stuff. And you know you can do your own pillars here. You have your own custom pillars you can do as part of our community when you sign up for our software. But here are 8 pillars. Now, guys, it's actually not bad, Mo.
Oh, wow.
Yeah, see, you even say, oh, I was looking for your reaction, because you're probably like, oh, I thought there would have been more.
Be terrible.
I mean, I'm actually surprised by this.
Doesn't bother me at all.
So, guys, the shares outstanding, only up 3.8% in the last 5 years. They're not really diluting investors that much. Nope. Although they just announced, didn't they just announce a share offering of $10 billion?
Let me check.
Can you look that up and verify? But guys, the big red flags here are 5-year PE and 5-year price of free cash flow are 190. I want to remind you guys, Tesla was the same way. And Tesla's down now 50, 60% from its all-time high. Now, you might argue Paul was that way for a while, but Tesla was a fast-growing small company with $1 billion or $2 billion in revenue as it was growing. This is NVIDIA. They have $25 billion in revenue. And yes, they have announced 50% increase in their assumptions for this next quarter on revenue. I get it completely. And they're going to crush these revenue numbers. Get it 100%. By the way, have you seen their dividend?
No.
It's adorable.
Oh.
Why even pay a dividend?
Bother?
0.04%.
Yeah, it sucks people in, I guess.
Does it?
Maybe.
It's puny. Free cash flow, $6 billion. 5-year average free cash flow, $5.3 billion. Return on invested capital, 15.8%. I'm actually surprised at this. I thought it was going to be higher than this.
Me too, especially for a company that's in their area with, actually, I thought their margins would be higher too. Oh,
no, but this is a chip. I mean, these guys, I'm actually surprised it was this high. Because I don't think other chip manufacturers have 61% gross margin.
Yeah.
Now, guys, 61% gross margin, what that means is...
They're not really getting into the high margin stuff yet.
Well, no, it's hardware. Yeah. I mean, it's hard to make... Like, look at Microsoft. Microsoft's 68% in their software. Mm-hmm. Guys, gross margin means for every extra unit they sell, 61% goes basically to pay their overhead and their income taxes. And when their overhead is fixed, a lot of that goes to the bottom line profit. And that's why their profit margin is so high. And if tomorrow revenue doubled, their profit margin would probably be higher than these numbers because they can double their revenue probably without much increase in their overhead. And that's a big factor there. And the overhead the things they do need to increase would probably be part of this gross margin. So guys, another big benefit of NVIDIA, another great thing, market cap to enterprise value.
Same.
It's exactly the same. What this means is there's essentially no debt in the company. Market cap is multiplying the share price by the number of shares outstanding, and enterprise value is buying the company in full, netting out its debt and its cash, literally taking and having no debt in the company and taking away the cash. So they're essentially the same price. That is awesome. Compare that to a company like Paramount Global, which has been up a lot lately. Market cap of $9.98 billion, enterprise value of $42 billion.
Wow.
That big difference right there is basically debt.
Wow. So
that's what I'm saying when I sit there and say that's a great balance sheet. And you want a great balance sheet in any company you buy. But you don't buy it just because it has a great balance sheet, just like you don't buy it because it has a great story. You buy it because the fundamentals make sense, and the present value of all future cash flows will give you a high return on your investment. So let's go check out the analyst estimates on NVIDIA right now. Wow. Jesus Christ. Okay.
I don't know.
Analyst estimates, earnings per share, $3.33 all the way to $13.
Okay.
So currently at 408, divided by 13 is 31.5. Is that right? 31.5 PE for 5 years out. Guys, this is selling for 31.5 times the profit 5 years from now. Does that mean it's unreasonable? I don't know. This is the very, very hard part about fast-growing hype businesses.
I mean, if everything that they're saying sticks, Sounds good.
But even then, are you willing to pay 31 times 5 years from now's profit?
I don't know.
I don't know either. Let's look at the revenue growth. Look at that. Here's the interesting part to me. The revenue growth numbers, 27.5 to 71. I would have thought much more than that.
Me too.
Look at Microsoft. They do $206 billion.
Yeah, what did NVIDIA
in revenue
do last year? 25 billion?
Yeah, they did 20. Yeah, I look at this going, man, so 5-6 years from now, they're looking at 71 billion. Microsoft's probably going to be at 280 or 300 at least, probably 350. And I don't know, you sit there and say, is this a reasonable price? Can you still buy it for 408 a share and get a good return on your money with all these things happening? If I told you right now that I'm going to sell you a company that generates $13.30 a share in 5 years, what would you pay for it today?
Less than that. Personally.
Unless it's a very, very, very early stage company
exactly. And I see a lot of promise and I say, okay, maybe I'll pay 13, maybe I'll pay 17. I don't know.
There is a lot of promise for NVIDIA. There's a lot of excellent stuff, but then at some point,
it's still $1 trillion company.
It's still $1 trillion company.
Doing 25, and frankly, from 2021 going into 2022, there was revenue growth, and now the revenue growth is declining. What if that's the new trend?
So I think this leads us right into our stock analyzer tool. But Mo, I usually do a 20-year analysis, and I'm going to do that still. But I think you should do why don't you do a 7 or 8 year analysis?
I think we should just do 5 and 10.
Okay, let's do that. I'll do a 10-year.
Okay.
Mo will do a 5-year analysis. And the reason being, guys, is we're going to make really ridiculous assumptions and see how reasonable this 408 stock price is. One thing I want to point out, though, a declining return on invested capital. That's why we believe that return on invested capital is so important. We put it up here at the top, the 1, 5, and 10 years. Now, your goal with our stock analyzer tool is to put revenue growth assumptions, and these are the historical ones, profit margin, free cash flow margin, assign a PE and a price of free cash flow, and then here at the bottom, your desired annual return. The higher your assumptions, the larger your return should be because it's putting in a higher margin of safety. And the higher your assumptions, the less likely they are to occur. So you need to have a higher desired return. So, Mo, revenue growth, low, middle, and high. What are you thinking?
I did 7, 14, and 21.
7, 14, and 21.
And frankly, I think that those are pretty reasonable. They run the gamut.
So let's see what 21% revenue growth for the next 10 years does.
Well,
1.21 to the 10th.
When I say reasonable, I mean for an extreme number.
It takes them almost $200 billion it's $175 to $200 billion in revenue in 10 years. Which, by the way, I think
it's fine.
Okay,
Yeah.
let me change yours a little bit then.
It's not outrageous.
I'm going to change yours. I'm going to go 7, 17, and 27.
Okay.
I want to be unreasonable.
Okay.
1.27 to the power of 10 would 11x them, and they did 28 billion. It would take them $300 billion in revenue in the next 10 years. Guys, just go look at the history of trillion-dollar companies growing 28% a year revenue for 10 years. Just go look at that history. All right, profit margin. Mo, give it to me.
21, 24, and 27. Maybe you can even go higher.
I'm going to go 21, 25,
29. 29?
Yep.
Perfect. Okay.
Because I want to go really high.
And
look at this, guys. Their 5 and 10 year profit margins have been the same.
Yeah.
So for them to get from 26 to 29, that's a big jump. That's a 10% increase in their profit margin. What about free cash flow?
I think same thing. They're very consistent with
I agree.
Between the two.
Okay.
Now PE.
This is the doozy, Mo. Because they're currently at 180 PE and 168 price of free cash flow. So everybody's going to say, well, they're going to do the meet Kevin thing of 70 is a reasonable number.
I almost think 20, 25, and 30. Because if they can do 27% revenue growth with 29% profit margin free cash flow, yeah, sure, I'll pay premium.
But what do they do 7? I'm going to go 15.
Oh, wow. Okay.
22 and 29.
Okay.
Now, the reason I did this, guys, is this is still an absurd number.
I agree.
It's still a really, really high number, especially in the tech business. Even with a declining return on invested capital, even if it's just a very hard pill to swallow for me. But I went 15 on the low side because, hey, if they only hit 7% revenue growth, it means that AI probably wasn't as big as they thought. Okay, they doubled their revenue in 10 years, fine. We'll assign them the market average of 15. Now, I think you can justify a higher PE than this, but we just sat there and put it in here. Desired return, Mo.
What do you think about 11, 14, and 17?
I agree completely. Guys, the reason we went higher up here is I think we'd all agree these are very, very tough numbers to hit. Just go look at the assumptions that were made about Amazon and Tesla. And even though Amazon and Tesla skyrocketed in price, they didn't hit their assumptions. They didn't hit their revenue growth assumptions all the time. It's very difficult, especially over a 10-year period. So we put in 11% return because I still want some return better than the market, but the lower my assumptions, I'm willing to take a lesser return. 14 is kind of like, okay. Actually, I'd make the argument this to be 15, but either way, 11, 14, and 17 feels good. We're at the analyze button. Ready, Mo?
Yeah. Let's see this.
Guys, this is how overpriced NVIDIA is. Low price of 40, high assumptions was 240, middle assumptions was 101. Even at our highest assumptions, it made the price 240. So before you leave, I want to show you what assumptions have to happen on the high side to justify this price. Let's first decrease our desired return to 10%. There you go. You're buying it today for essentially a 10% return on the highest assumptions. It's at 428, the stock's at 411.
I'm not willing to make that bet on the highest assumptions.
That's the question. Is your money so invaluable to you that you want to make a 10% return on very, very high assumptions? A high PE, a high growth rate, a high profit margin, the best of every attribute. All right, so as you see, there's a lot of value here, and you can have all the software, all the tools attached here, all the tools that are coming. But most importantly, we have a community of thousands of investors who are like-minded investors who sit there and can have a conversation, who've done their research on companies. You can engage in that. And this is all available for only $1 per day. And guys, the best part is we're actually running a special, $7, 7 days. Try it out for $1 per day at everythingmoney.com. If you like this, I encourage you, subscribe to the channel. You're going to learn a lot more. You're going to learn a lot more about our process. And if you're ready to skip right to the software for $1 a day, everythingmoney.com, check it out. Thank you very much for your time.